So we live in a time of crisis. I would start with Brexit. It's my personal list of crises, maybe I'm parochial. And then came Trump's presidency, COVID, climate change was already there, but it's gaining, it's becoming ever more central to the way we think about things and we live our lives. And hopefully now the Ukraine war. So it's fair to say that crisis has become the.
Sorry, Luca. Could we ask you to put the microphone on, because in the back row we can't hear you very well. Thank you.
Okay. And so this panel's task is to discuss what lessons can be learned from the world we live in and all the crises, the systemically relevant events that we've been going through in the last few years, and how national and international stewardship frameworks have adapted or can be adapted to address these uncertainties. Have investor practices changed, and how have they changed? So let me briefly introduce panelists in alphabetical order. We have first Mark Manning, who leads the FCA, the Financial Conduct Authority's policy work on sustainable finance and investor stewardship. We have Emmet McNamee, who is head of stewardship at the PRI, the Principle for Responsible Investment, and as such is in charge of leading the Active Ownership 2.0 initiative. We then have Andrea Tweedie, who is a stewardship manager at the Financial Reporting Council, and Kerrie Waring, Chief Executive Officer at the ICGN, the International Corporate Governance Network. So we will start from Kerrie, and each panelist will have 10 minutes. Then I will ask them a question, and then we'll open the floor for Q&A. Okay.
Thank you. Is this on? No. Thank you very much, Luca. And let me say how fabulous it is to be here in person. I'm just so excited to catch up with lots of you today. It's just amazing. Lots of ICGN members and friends here, so that's brilliant. Really interesting to hear from the first panel. You know, I always think about the evolution of stewardship starting actually back with Sir Adrian's Code in the mid-90s. We clearly had Section E describing very clearly the responsibilities of investors to make considered use of their votes, to engage with companies and conflicts of interest and so on. And just also to give you a bit of background about the ICGN, and this is more a point in response to some of the comments around perhaps the lack of sophistication perhaps within the institutional investment community. I actually think that ICGN members, and today they represent around $70 trillion worth of assets under management. We've got around 30% US or North America, 40% Europe, about 22% Asia, and then rest of world. They are a very synergistic group. They engage regularly and across the board. So I would like to think that the investor community, together with organizations such as the Investor Forum, many of these national investor bodies like AXI that was mentioned, do a fantastic job in bringing consensus together and engaging together with companies and policymakers for the furtherance of stewardship. To prepare for today, I thought I'd go back in time a little bit, and a little known secret is that one of the first ever stewardship codes in the world was one published by ICGN in 2003. And I thought what I'd do is look at this and then look at our most recent publication, which is the ICGN Global Stewardship Principles published in 2020. And what's really interesting is that the fundamental pillars of what we call stewardship hasn't actually changed by a tremendous amount. The 2003 statement that ICGN published described investor fiduciary duties to preserve and enhance long-term corporate value on behalf of beneficiaries or clients, responsibilities to improve high standards of governance in investee companies, investee company monitoring, voting and engagement, and can you believe it, on themes such as the management of ethical, social and environmental risk, Marco. Vote disclosure, conflicts of interest, even stock lending gets a mention, reporting to clients, basically all of the core pillars that you would totally expect to see in the 19 codes that we have around the world today. I think what has changed is that we now have a greater appreciation of all of the factors that impact the long-term success of companies beyond traditional financial parameters, as Dan was pointing out, such as human, social and natural capital management, and how companies then externalize their impacts on societies, the environment, and on economies. If I was to point to more specific changes over the last 2 decades, comparing both of the codes, there's clearly more focus on the internal governance arrangements of the institutional investors themselves. So looking at leadership, independent oversight, resources, remuneration practices, essentially practicing what we preach. Scope of stewardship has been expanded far beyond equities and is now applied in nearly all codes, by the way, across all asset classes. Investor collaboration is far more elevated than it used to be. And by that, I mean in terms of not only engaging with companies, but also with governments and policymakers. And of course, the conversation has changed much more towards environmental and social priorities. Dare I say it, at the expense of governance priorities. We really must go back to basics and not forget that if you don't get the G right, we're not going to achieve any of the sustainability and environmental outcomes that we all desire. I think a good example, in fact, of how perhaps the conversation has changed is to look at the ICGN Global Governance Principles. Now, this is a really important document in the world of governance, and I should introduce you, by the way, to George Dallas, our policy director, who leads much of our policy work together with me. So it's brilliant that he's here. But George and I and many ICGN members in this room last year worked very hard in updating the ICGN Global Governance Principles. Now, I'm telling you this because if you think about the 70 trillion that our members collectively are responsible for, they use the ICGN Global Governance Principles in their voting policies and their company engagements. So if you amend the Global Governance Principles, it's quite a big deal. And I have to say, I've been at ICGN for 14 years now, and it was perhaps the most innovative suite of changes that we've ever seen. It was much more sustainability focused. We've got lots of references to things like climate-related reporting, double or dual materiality, global sustainability standards, human rights in the supply chain, and so on. What's next in terms of stewardship? Well, in fact, I should thank you because the FRC are hosting us later this month on the 22nd of June. Thank you very much. To host the launching of what we call the model mandate. Now, this again, and if Paul Lee is in the room, I don't think he's here yet, but many of you in the room will know that the ICGN model mandate that was published in 2012 really was a seminal document at the time, under the leadership of Paul Lee and the ICGN Shareholder Responsibilities Committee. Now, it was developed to provide asset owners with a way to align the interests of their fund managers with their own obligations to beneficiaries and by reflecting stewardship obligations in investment management agreements. So, for example, it provided a series of example contractual terms around things like alignment of investment risk and opportunities, internal governance, incentives and performance, portfolio turnover, reporting to clients, all of that good stuff. But we thought we would update it this year in partnership with the United Nations supported Global Investors for Sustainable Development Alliance. Can't believe I said that without tripping up. And actually, you all know Chris Hodge, who brilliantly led the redrafting of the document for us and consulted with members to produce this new document. We did it largely in response to regulatory developments around the world aimed at promoting transparency and engagement between asset owners and their managers around how they assess stewardship and sustainability factors in their decision-making processes. Additionally, as has been discussed, the swathe of stewardship codes around the world has really emphasised the importance of responsible ownership. And again, not just in the interest of, direct beneficiaries or clients, but of course in the interests of sustainable economies, societies and the environment. And alongside this is, of course, the increased and ongoing public and political expectations placed on investors that they should make a positive contribution to things like the United Nations Sustainable Development Goals. So the revised model mandate provides draft clauses for sustainable development investment, which aims to support the achievement of one or more of the Sustainable Development Goals whilst continuing to maintain a financial return. So, for example, some of the new draft clauses are around reducing greenhouse gas emissions to achieve net zero targets by 2050 and committing to the Task Force for Climate-Related Financial Disclosures, recognising the impact of biodiversity loss to the health of our planet and committing to the Task Force on natural, Debbie help me out here, nature financial disclosures, the opposite of TCFD, identifying potential human rights abuses across subsidiaries and supply chains and supporting standards such as the OECD guidelines for multinational enterprises. I mean, I must admit that most, if not all of the additions to the ECGI and GISD model mandate are related to environmental and social priorities. But we also recognise that there are many other systemic risks that investors need to address, not least the impact of COVID, which has elevated the importance of social factors as a key determinant of a company's long-term success and economic prosperity. And other systemic risks high on the agenda beyond COVID and climate include data security and digitalisation, global economic disintegration due to the geopolitical disharmony we now find ourselves in, whether that is due to the Chinese and US discord, Brexit and fragmentation effects in Europe, or Russia's war in Ukraine. All of this, I think, really elevates the importance of governance and stewardship to help ensure that companies can manage efficiencies, mitigate risk, and ensure resilience so that they continue to preserve and enhance long-term value for all of us. So I think I will stop there, Luca.
Great, thank you.
Just quickly, we've got some people standing, so if we could just get them to come through this way. Cheers.
Well, thank you, Kerrie, for these thought-provoking notes. I would now leave the floor to Andrea. Thank you.
Thank you very much. Hi, everyone. It's a pleasure to be here today. Again, in person is lovely. So as you may know, the UK Stewardship Code is a principles-based stewardship code, which we at the Financial Reporting Council have been responsible for since 2010. And so the current code is actually the third iteration of these principles, and the code has very much evolved over time to get to the framework that we have today. I want to talk about three things with you today. So firstly, the benefits of a principles-based structure in times of uncertainty. Secondly, the key elements of the stewardship code that we think signatories might be focusing on in these changing times. And finally, the role of stewardship reporting and why that is an important part of any code or framework as well. So why is a principles-based code important in times of uncertainty? Well, put simply, we think it's important that stewardship frameworks should have enough flexibility to respond to times of uncertainty and also just to the changes that inevitably happen over time. And we think that principles-based frameworks rather than rules-based are better suited to this and able to adapt and evolve. We also see that stewardship as a discipline is becoming better recognized, and it's continuing to evolve in itself as well. And some of the ways that we're seeing this manifest are that the accountability for stewardship is sitting at kind of higher levels within organizations. There's also stronger relationships and interaction between portfolio managers and the governance and stewardship professionals. And so there's really an increasingly important role for stewardship frameworks to play. The UK Stewardship Code is made up of 12 principles, and while we expect signatories to apply them all, we don't prescribe one single correct way to do so. So we're not trying to drive everybody down a single narrow path of what your stewardship should look like. What we really want is for signatories to tell us, but more importantly, their clients and beneficiaries, what they're doing and why they're doing it. And then there are also some elements of the code in particular that I want to highlight as really important to think about when we're thinking about uncertain and changing times as well. So one of them is Principle 2, which is looking at governance and resourcing that you have in place around your stewardship. So there are a few things that can really help you think about how well you're set up to deal with an uncertain environment. So have you got strong and clear governance structures in place to support decision making in times of stress? As well, how well resourced are you? Do you have adequate and dedicated resource? And how are people being trained and incentivized in their stewardship? As well, looking at Principle 3, which is on conflicts of interest. So have any of the potential conflicts that you face changed as a result of new market circumstances? How are you keeping an eye on these? And also kind of, have you thought about making sure that people are approaching this with a mindset that's thoughtful about conflicts of interest that might arise in times of stress and uncertainty? And as well, when we were consulting on the latest update to the code for the 2020 code, one of the new elements we added was our Principle 4, which is seeking to understand approaches to systemic risks. So how are you identifying, monitoring, and also responding to systemic risks? For example, inflation or climate change and the pandemic. So this principle really sets the expectation that investors are going to work together to address systemic and market risks and contribute to a well-functioning financial system. We think that investors are privileged to be looking after the capital of pensioners and savers. And then with that comes the responsibility, but also the opportunity to work with others to improve how markets function. And so what action can investors take? It's about identifying the risks of greatest importance and the areas you can have the most impact, and then making a valuable contribution in that area. So that might look like having a collaborative engagement with an issuer that has significant impact, or maybe it's working with others to change regulation or practices or reporting. And then, of course, across the UK Stewardship Code, there are also principles on ESG integration and engagement and exercising rights and responsibilities. So think about what changes you might be making here. Are your priorities shifting? You know, have you escalated activities to respond to different circumstances? How are you then reflecting this in your relevant voting policies? And just more widely, what systems and processes and inputs do you have that are going to allow you to respond to any new and arising issues? Now, as well, I couldn't possibly sit here today talking about the Stewardship Code without talking about stewardship reporting as well, and I think any signatories in the room would expect nothing less. So one of the key features of the UK Stewardship Code is that signatories need to produce an annual report that covers their activities and outcomes. And we do get it. We know it's not an easy ask to do that, but we think it is really important to help the Stewardship Code play its part in supporting a market for stewardship. We need some degree of transparency that's going to allow for comparison of different stewardship approaches across the market, and reporting is an important piece of that puzzle. And also we know that it's a constantly evolving and rapidly developing industry, and we're also operating in kind of an uncertain and changing landscape. So we don't expect everybody to have the right answers from the very start. But the Stewardship Code framework, it really allows and also kind of supports that reporting of activities and outcomes along the journey and over several periods. So we don't need for every engagement to fit really neatly into a calendar year, so you can write a nice case study on it. But what we're interested in is what has happened in this year, how are you reflecting on your progress to date, and what are your plans and expectations for the next steps? And of course, we also recognize that reporting on outcomes may be challenging, and it can't always be attributed to one investor or to one particular action. But we do believe that it is important for clients and beneficiaries to be able to assess the impact that their pension fund or their asset manager is having from their efforts, and also for those signatories to report on how they're reflecting on their effectiveness as well. So at its core, the UK Stewardship Code encourages a long-term perspective, but also keeping that focus on what the steps are and the outcomes are along the way. So in your reporting, whether it's on an issue that's more emerging or something that's more established, you are very unlikely to have all the answers from the get-go. So it's really about showing what you're doing to take the best approach you can at the time and then to keep building on that. So to sum it all up, we think that the principles-based nature of the Stewardship Code works really well to respond to uncertain times and a changing environment. You can really think about using the code as a framework to, think through what the challenges are and your stewardship, and then try to produce reporting that tells your story and it really explains what you're doing, what the outcomes have been, and what you're going to do next. So as well, I'll just let you know the FRC has lots of resources to help existing and prospective signatories to do that. We've got good practice reporting guidance. There are lots of webinars and podcasts, and they're all on our website. So I encourage you to have a look at those, and then as well, be in touch if we can be of any help. And as well, don't forget, so the reporting that we have of signatories to the code to date, and we've got just under 200 of those, it's not just a wealth of information for clients and prospective clients, but it's also a great reference point if you're thinking about your own stewardship and see some different approaches as you think about your own reporting as well. And I'll leave it there. Thank you.
Thank you, Andrea. And I will leave the floor immediately to Mark.
Thank you very much indeed. Well, great pleasure to be here, and thank you so much, Dionysia, for the invitation to join this session today. Experts, I'm really looking forward to some of the discussions in the margins, as well as all the panel sessions over the course of the day. So I would just like to give a little of how we've been thinking about stewardship at the FCA over the past few years, some of the actions that we've taken the FRC in many cases, and with industry participants as well over the past few years. And then I'll talk a little bit about some of the important initiatives in this context of an uncertain and changing world, and in particular some of the work that's underway in relation to stewardship in respect of climate change. So let me start with just a little bit of recent history of FCA regulatory considerations in this space. So back in 2019, we worked on a joint piece with the FRC, a discussion paper looking at the regulatory environment for stewardship and where there might be need for further regulatory intervention or further industry action in order to drive us towards more effective stewardship. And that discussion paper also influenced the 2020 Stewardship Code, which Andrea has just been talking about. So in that piece, we really emphasised how active ownership through effective investor stewardship can influence market quality, can support asset managers and asset owners in delivering value for their clients over the long term. That's really at the core, and that's why, as the Financial Conduct Authority, we care. This is all about how we can ensure that stewardship can play its part in asset managers and asset owners that we regulate as the Financial Conduct Authority deliver on their duty to customers. So that puts it really at the heart of the investment process. It's not just an add-on, it's not just a nice to have, it is integral to being able to deliver for consumers of financial products over the long term. And the work that we did with the FRC in that discussion paper was really linked also to the UK's implementation of the revised Shareholder Rights Directive, which in the EU, we were still bound by EU regulation at that time, was really focused very much on short-termism in markets, and set out to set regulatory expectations in respect of engagement strategies and how they're disclosed and how asset managers can be held to account for the activities they take. And these were very similar concerns to what we saw in the K review a decade ago. Very similar considerations and very similar drivers of regulatory change and expectations. So in the work back in 2019, we highlighted 4 attributes of effective stewardship. The first of those was a clear purpose, and that clear purpose should be shared across the institutional investment ecosystem. Ultimately, there needs to be a clear understanding between the asset manager and the asset owner as to what they're seeking to achieve through stewardship and how that is going to impact investment decisions and investment processes. The model mandate that Kerrie's just been talking through is exactly a way of driving that shared understanding of what we're looking to achieve. But it's not just between the asset manager and the asset owner. It's also all the other parts of the ecosystem that have an influence here. It's the proxy advisors, it's the investment consultants, it's the data providers. All of these have a critical role to play, and there needs to be a shared understanding of how those interactions are going to support an ultimate goal of delivering long-term value. The second attribute that we talked about was constructive oversight of assets, engagement, challenge. How can all of those stewardship tools be delivered to the best advantage? And I think a really key aspect that we called out and explored within the paper was about integrating all of that within the investment process. So this isn't just the activity of a stewardship team sitting on the edge with no power and with no great visibility within the organization. It needs to be integrated with the investment decisions that portfolio managers are taking. The next one was institutional culture and organizational structures that support effective stewardship. And this is about leadership. It's about tone from the top. It's about it being part of the ethos of the organization. Not something that's very easy to regulate. It needs to be grown from within and delivered in some respects as a set of core values for how the organization operates. So that's another important area of focus. And I think we have seen over the last few years quite a lot of movement in that direction, certainly among some of the leading organizations in the area of stewardship, some of whom I can see in my eye line today. And then the final piece is disclosure and transparency. Disclosure and transparency all along the investment chain. Again, Andrea's just talked about stewardship reporting in the context of the stewardship code. Absolutely critical. Telling a story, delivering a very clear narrative around what has been achieved, what actions have been taken, and how those actions have supported outcomes that again link back to stewardship objectives and link back to the long-term value creation for clients and consumers. But there are, of course, barriers here. There are barriers, informational barriers. There are incentive barriers. There are barriers that simply arise due to the frictions of relying on all the different points in that ecosystem that I described to work together. And I think they can only be, some of those can be addressed through regulation, but many need to be addressed through industry participants working effectively together. And each of those points in the ecosystem developing a shared understanding and shared value. And there's been great progress in that direction as well. The work that Kerrie's talked about in terms of the model mandate is a great example of that. We have the investment consultant stewardship working group that's come together to think about how investment consultants can best support their asset owner clients on this journey, and many other examples besides. But I want to talk about a couple of things that we've done in the context of informational barriers. So in a world in which a significant area of focus for a lot of stewardship activity has been climate change and has been the transition to net zero. One of the important considerations there has been, how can we ensure that the right information is in the hands of asset owners and asset managers such that they can hold their investee companies to account and can act effectively in their stewardship initiatives. And so there we've taken steps to implement TCFD aligned disclosures by listed companies in the UK, ensuring that information flow comes into the financial markets, and then also introduce TCFD aligned disclosures for asset managers and asset owners, so that information can flow along the investment chain to clients and consumers as well. And that's very complementary to the specific stewardship reporting that occurs under the Stewardship Code by Stewardship Code signatories. That's just one example of that information flow, but we also need to ensure that the information is best directed towards the drivers of long-term change in the case of climate change. And that's why another really important initiative that we're engaged with at the moment is the Transition Plan Task Force that the government set up earlier this year. So back at COP26 last year, the Chancellor announced that he wants the UK to be the world's first net zero financial centre. Really important, bold statement. And that came alongside all these other bold statements around net zero commitments by those that control 130 trillion of assets across the financial sector. Great to have those commitments, but how are they going to be achieved? And that's where transition planning, detailed transition planning comes to the fore. We need those commitments to be backed up by a very, very clear set of strategies to ultimately deliver there. And that's what the Transition Plan Task Force is seeking to support. There's a call for evidence out at the moment. I hope many of you have seen it, and if you haven't, please do take a look. It's on the website of the Transition Plan Task Force. The idea is to set a gold standard of what a good transition plan looks like. But that transition plan needs to be achievable for the preparers to develop and disclose, but it needs to be decision useful for the users. And one of the important purposes for which that information should be used is to hold investee companies to account for their net zero plans and be able to act effectively on those. We really do see it as a very important development to put the right information in the hands of effective stewards. And in conjunction with this, we're planning to do a bit of road testing. We're doing that jointly with the Transition Plan Task Force and with members of the Stewardship Regulators Group, which was set up a couple of years ago. The FRC are the chair of that group. And we want to ensure that we can see the feasibility of preparing disclosures in accordance with the eventual outputs of the Transition Plan Task Force. And we want to see users of that information being able to leverage that information effectively in their stewardship activities and in their investment processes more broadly. So really important initiative, and I think one that speaks very strongly to one of the key uncertainties in our world today, that of climate change. Thank you very much indeed.
Thank you, Mark. And Emmet, now the floor is yours.
Thank you. Like my co-panelists, also very happy to be here in person, although I'll confess that I'm going to miss just being able to subtly read my notes from the screen instead of trying to interpret the chicken scratch that I brought with me. But to zoom out a little bit, I mean, we've been talking about stewardship frameworks, but stewardship frameworks are sort of one part of the overall responsible investment framework. And, you know, to put it very simply, I mean, we would look at two sort of contrasting, not opposites, but sometimes in tension axes of asset allocation, security selection on the one hand, and stewardship and use of influence on the other. And I think increasingly lately, there's the tension between these two is becoming clearer. And so, for example, to look at some of the more interesting regulatory developments in the last few years, I would say would be the EU taxonomy and the Sustainable Finance Disclosure Regulation. On the one hand, these have very clear stewardship applications and use cases. I mean, it's a way to identify priority companies to engage with. It's a way to frame engagement asks around, minimum alignment with the taxonomy in capital expenditure plans. But I think overall, what's happening in practice is that there's an expectation that these tools will be used to just primarily ask, how sustainable are the assets in your portfolio, and not focus so much on ownership practices. In a similar way, net zero commitments have this risk. If you look at how the net zero alliances are framing this challenge, there's a very clear and deep understanding that divestment is not going to get us to net zero, that engagement with companies, with policymakers is going to play a crucial role, that there's a risk that we might end up seeing a divergence between the portfolios of a subset of leading investors and the real economy, which largely remains unchanged. But despite that appreciation, there's still this, there are reputational risks from investors who can't quickly enough demonstrate progress, being called out by beneficiaries, the media, their stakeholders, that they're still invested in these companies that aren't transitioning fast enough. There's also the resource intensity of doing good engagement, the free riding effects that take place. And so divestment in many cases is increasingly being seen as an easy out. And so, which again, sort of blunts the use of stewardship as a tool across the industry. So stewardship is operating under these kind of meta constraints. And I think this is particularly important when you think about the role that leadership has historically played in stewardship. A colleague of mine recently published a paper which found that the vast majority of the changes in environmental and social performance of companies over the last several years could be by and large explained by the activities of just about 20 investors, which constitutes on average about 2.2% of the shareholding of an individual company. And so if the leadership that we as an industry encourage and reward is primarily focused on asset allocation, we're going to see a lot less of these leaders taking on these big challenges and driving change at the portfolio companies. All that being said, this disillusionment with stewardship is to some extent a misery of our own making, I would say, insofar as the weak stewardship and engagement practices among many investors for a long time has led to skepticism among other stakeholders about what investors can do and what investors will do. And so, what can be done about this? How can this change? I mean, you've already heard from others some of the key ways in which this will happen. Two that I would focus on are in part the asset owner, asset manager relationship, as has been discussed, and the investor-investee relationship. On the asset owner, asset manager side, I think it's apparent that, as Mark has said, regulation can support this and play a very influential role, but you're ultimately dependent on asset owner demand to build a robust stewardship market. And I think that the selection, appointment, and monitoring processes of asset owners when it comes to stewardship do have some improving to do. There's an increasing appetite among asset owners to seek out asset managers that have a stewardship policy that is aligned with their own. The problem with this is that many of these stewardship policies from the asset owners are very high level, very generic, and in some cases so much so that it'd be quite difficult to find a manager that is not in some way aligned with this policy. They're increasingly featuring stewardship questions in due diligence processes, but again, there isn't a very clear idea about what a good answer to these questions look like, or if there is, they're given much less weight compared with other considerations in the selection process. And so what can we do about this? I mean, so I think the work of the ICGN and its great new model or revised model mandate can really help with this. More broadly, I think asset owners just need to take greater ownership of the outcomes of the stewardship of their investment managers. Partly is about demanding transparency. I think so many voting policies of investment managers leave a great deal of flexibility, which is important, but when 50% of a voting policy is we approach this issue on a case-by-case basis, I think that poses real problems to asset owners in selecting an appropriate manager. And as well, I mean, as others have said, I think stewardship, there's an appreciation now that stewardship is a lot broader than just relationships with the investee company. And so asset owners also need to look at the policy engagement approach of their asset managers, to what extent they're engaging with their trade associations, standard setters, and deploy a much broader set of levers than they have in the past. On the second dynamic, the investor-investee relationships, I think this has moved quite fast in the last few years. I mean, if you were to look at the support for ESG-related shareholder proposals, it's really rocketed in the last couple of years, which I would say is triggered in significant part by asset owners deciding that this is sort of a metric against which they wish to measure their asset managers. Now, it's a very blunt metric. I mean, we know that there's a very great deal of variety in the quality of ESG shareholder proposals, but I still think, you know, in aggregate, it's a positive step. And it seems to me that the next kind of metric that asset owners are going to use, or that asset managers are going to attempt to distinguish themselves against, is on the approach to investee boards of directors and their ESG performance. I think this is critical. I think even the best worded shareholder proposal that gets significant support from shareholders still needs a supportive and informed board to implement that. I think that there's been in the last few months prior to this proxy season, there was a sort of flurry of announcements of various managers who were taking varying approaches to voting against directors on different issues, which I think is, again, positive. I think we do need to get beyond a signaling kind of approach. A lot of these policies are like, we will vote against X director if this crisis has already happened, if there's been a very serious social or environmental controversy. And I think investors need to think about this a lot more proactively, actively seeking to shape boards that are ESG competent, that have relevant skills to any strategic ESG issues that they're facing. Perhaps getting a bit more involved in the nomination process in certain cases. And I think, there's been, some statements from various investors lately about the sort of skepticism about the quality of ESG shareholder proposals, or the risk of micromanaging companies through overly prescriptive shareholder proposals. And I would say, if that's your concern, then this issue around getting the right boards in place is even more critical. So I guess just to sum up, I think we as an industry need to value stewardship more within the overall RI framework, but also to some extent we need to earn that valuing more through more robust approaches to stewardship. So I'll stop there. Thanks.
Thank you so much, Emmet. So now it's my turn to ask questions, and I will follow the same order. So I will start with you, Kerrie. And so you spoke about the changes to the ICGN global governance principle and the model mandate as well, and how stewardship practices have evolved, are evolving. And my question is about how what you are doing in this area complements what's happening in the regulatory landscape, of which, of course, we have heard more from other panelists. And so how does ICGN itself, if I may use the word acts as a steward within the regulatory and policy-making arena?
Thank you for the question. So one of the key benefits of ICGN membership is the fact that as a member, we represent your interests in various markets when we write letters and respond to policy consultations. So, for example, in Asia, I serve on the Japan FSA's Council of Grandly Titled Experts, and we advise on the Japan Corporate Governance Code and the Japan Stewardship Code. And my remarks to the Council draw directly from member feedback, which is encapsulated in the Global Governance Principles or Stewardship Principles. So it's a really interesting way of seeing market opinion being transposed into national codes and guidelines, or indeed even in regulation. We issue, I say we, George primarily issues dozens of letters a year. And he does that by working with 5 excellent policy committees, all made up of ICGN members, 3 of which are technical in focus. So they focus on financial, human and natural capital management. And then George and the policy team pull the letters together and we send them out. I mean, by way of example, we've actually submitted in the last 5 months 14 letters and policy statements. There are only 17 people that work at ICGN. We don't have a staff of more than 200 or whatever. We were a small team. So it's some going, and George is pretty busy most of the time. But I think to answer your question, to give you an idea of the flavor of different regulations and consultations that are going out there, of the 14 we submitted, 3 concerned corporate governance reviews in Japan, Germany and the Netherlands, 3 focused on sustainability reporting in Europe and Canada. And at the moment, we're working on responses to EFRAG, ISSB, and the US SEC as we speak almost. We issued 4 letters to the US SEC, primarily on what you might call boring governance aspects, so insider trading, share buybacks, that kind of thing. We did 2 statements on Russia's war on Ukraine. The first statement largely focused on the rule of law and human rights and democracy. The second statement was focused on anti-corruption practices. And next week, we're submitting a response to New Zealand's consultation on modern slavery. So it's a suite of things, which I say are generally aligned with our programme.
Thank you, Kerrie. You're pretty busy, you and George. So, Andrea, you told us highlighted the importance of accountability, especially in the form of reporting according to the stewardship code. And I was wondering, which changes, if any, have you seen in response to the COVID-19 pandemic?
Yeah, thanks. So we've seen a lot of stewardship reports over the past year or so, and a lot of varied reporting on the COVID-19 pandemic, from some stewardship reports that have covered it kind of in a really comprehensive way to some who, for a calendar report of 2020, had not one single mention of the pandemic, which was a bit surprising. We also saw a lot of reporting that was more focused on how has that particular organization transitioned to working from home, you know, have their business continuity plans gone smoothly, how they're looking after the well-being of their own workforce. And of course, that's all important, but I think in the context of a stewardship report, we want to see more than that. So what are they actually doing in terms of responding to COVID-19 as stewards of their assets under management? And what are they doing on behalf of their clients or beneficiaries in terms of, are they getting involved in any relevant market initiatives? What have been their roles and participation in those? How has it translated to their engagement with investee companies, and also into any relevant voting policies? So I think it's not irrelevant what you're doing internally, and that is part of the UK Stewardship Code framework, to say how you're set up, how you're supporting your staff as well, but it's also about what you're doing in terms of your stewardship.
Thank you, Andrea. So, Mark, one of the underlying themes of your comments, but also others, is about how investor stewardship can help to embed and hopefully accelerate progress across the real economy in tackling specifically climate change. So the obvious question is, what can regulators, investors, and possibly other stakeholders do to make stewardship more effective in this role? If you have to name three things, what would you put first on your list?
Thank you very much, Luca. So I think there are quite a few actions that can be taken by regulators and others to embed and accelerate, as you say. I guess one of the first is to really be able to encapsulate in a easily accessible and digestible way stewardship effectiveness. So Andrea's been talking quite a lot about stewardship code reporting and the nature of some of the reporting that the FRC have seen through the by signatories or signatory applicants to the stewardship code. I think one issue we really have is that there's going to be an awful lot there, and you've got to cut through the lip service stewardship to identify the genuine stewardship practices. Now, the step up to the 2020 code has been tremendous, and the shift away from policies and processes to activities and outcomes has been tremendous. But we don't yet, I think, have industry accepted metrics, if you like, for what good stewardship looks like. And I think that's potentially problematic as we see the role of stewardship being increasingly important in driving the transition to a more sustainable future, and where we need to bring end consumers of financial products along in the journey. End consumers of financial products are not going to read through a 30-page stewardship code report. They want confidence that their providers have undertaken effective stewardship on their behalf in the products that they're invested in. And I think this is particularly important when we think about the growth of ESG or sustainable investing. We're engaged in a lot of work at the FCA at the moment around classification, labeling, and disclosure of sustainable investment products. Now, we need those disclosures to sort of really capture what firms are doing in respect of those products. And if stewardship is going to play an important part, that stewardship activity needs to be communicated in a really pithy and accessible way. Otherwise, it's just not going to be trusted that activity is indeed taking place. So I think we potentially need more work above and beyond what we see today in terms of stewardship reporting to really home in on how we can capture in an accessible way stewardship effectiveness. And that might require more action on the part of the firms themselves in terms of maintaining an audit trail of how they are traveling in respect of their stewardship objectives, how they are escalating when they aren't having the influence they desire. And potentially that leads to divestment as a last resort if they're not gaining traction in their portfolios. And that journey needs to be captured in some way. I think a couple of other quick points. Stewardship across asset classes. So much of what we've seen in the stewardship space has been very much focused on shareholder engagement and stewardship as a shareholder. But we need also to see that stewardship activity extend across asset classes. And we need perhaps more work across the industry to establish how stewardship of fixed income, for instance, can be more effective. I've only covered 2, but there's only 1 minute remaining, so I I suspect Emmet is next.
Yes, thank you. So Emmet, you have mentioned the greater involvement of investors in corporate governance with an ES angle as well. And the question is, do you think that we'll see many more instances of collaboration basically between large investment funds and small hedge funds like engine number 1 in pushing companies in the direction of more ESG friendly strategies and so on?
I think yes and no. I think that if you look at the ExxonMobil proxy fight, there was many circumstances that were very particular to that event. You had a company that was unusually very openly disdainful about the key ESG risk that it faced. I think more often there's a lot of greenwashing and gaslighting and all the rest. And I think as well, it was a massively risky campaign led by one hedge fund who was deciding to, announce themselves on the world stage with a bang. Are those particular circumstances going to repeat themselves very often? I would say probably not. And it's probably an unhealthy expectation for investors to wait around for a white knight to come in and save the day. That being said, and there's also the risk that for the sort of risks that we're talking about, it's a very different sort of return model in that the traditional realm of small hedge funds has been in, securing buybacks, increased dividends, the sort of thing that pay off in the very short term, and so require, they're compatible with the smaller holding periods that hedge funds tend to possess. If you're looking to make a return from, an ExxonMobil or a similar on the ESG performance, you'd need to wait around for a lot longer for that sizable investment to pay off. I do think it's something investors should be looking at. Hedge funds are ultimately, trying to make a name for themselves in this space as well, to pivot to some degree to account for that demand. But yeah, in short, I think investors need to accept that to get this work done, they'll have to take a more active role themselves.
Thank you, Emmet. So, Dionysia, can we take until 11:05 because we started a bit late? Because I can't resist, because giving the floor to participants to ask an additional question, a short one, and whoever wants to answer, and not necessarily for everyone. But what I have gauged so far is that it's already difficult to be good stewards if your goal is maximizing your portfolio value. It is even much more complicated to do that while taking care of the planet. There are clearly trade-offs, not only between portfolio value maximization and saving the planet, but also on what to do to save the planet, and whether it's the E or the S that you look at more. And so that's fiendishly complicated to me. So my question is there a case for managing expectations of everyone, basically the ultimate owners, the consumers of financial products, the asset owners, and so on and so forth? Do we need to be careful not to overpromise on these, on what we are doing here? Anyone?
I'll have a first stab. I think there is a risk of overpromising. It's actually something that we've been thinking about quite carefully in the context of the work that I mentioned around labeling and classification of sustainable investment products. As a starting point, we believe that if you are going to be marketing a product as a sustainable investment product, you should have, alongside your financial return objective, some sort of sustainability objective. But that sustainability objective needs to really reflect what you are truly going to be able to commit to do, and what you are truly going to be able to be held to account to deliver. and that means it needs to be measurable. So there are very, very few funds that will be able to actually commit to a positive, additive, measurable, real-world objective. Beyond that, I think the best that a fund can do is say that they will be pursuing a financial return, but they will be doing so by investing in assets with particular sustainability characteristics, and those sustainability characteristics are plausibly linked to some real-world outcome, but they're not going to be able to measure the contribution that they are making, and thereby be held to account for that. So they can be held to account for how they're investing the assets and the characteristics of those, but in terms of the actual contribution they're going to have to real-world outcomes, it's going to be far more tenuous and far less measurable.
Anyone else? You're not.
No, I didn't mind.
And then Eva has a question, so maybe we can.
So I think it. But do you want to go? Well, the question's been answered. Move on to another one. That's fine.
Yes, if you don't mind, because we do have also questions from the online attendees. So I would like to give some priority to the online ones first, because it's a hybrid event. So do not forget, even though we cannot see them, they can see us and they can hear us. So they have questions.
Shall
I read one of the questions of that? Yeah. Yes. So it's from Alice Klettner. She's in Australia and one of the contributors to the book. So Alice is asking how we can deal with any potential conflicts between global and local stewardships. I think that this is probably a question for Kerrie. So the question is, so if you're a global investor and you are an ICGN member and you follow the ICGN principles, but at the same time, you invest in Singapore, Hong Kong, China, Japan, and you invest in so many different local markets, and there are so many different rules, but also different stewardship principles within those markets. So how you can really deal with that? So what is the role of the global ICGN principles there?
Is that all from
yes,
the
from
online
Alice,
audience?
everything from Alice.
So Eva, Marco, and Dan raised their hands. Can you quickly ask your questions?
Yes, very quickly. So I'd like to build on your existential question. Are we expecting too much from stewardship? By adding to that, asking, to what extent do you think stewardship is a way for the government to avoid very difficult decisions about regulations on environmental and social and perhaps even also governance factors?
Thank you. Marco?
Yeah, mine is a practical question, which is about duplication. So we have two international organizations, PI, ICGN. We have one national stewardship code provider. Of course, we know from the book that there are many more. So you sign up to multiple of these standards. You have to report. I mean, how does the community of writers of stewardship codes avoid duplication to make it more effective?
Dan?
Yeah, and mine is for Andrea. I don't know if you know how famous the FRC is in Asia, because Asia, all of the codes are government codes, which is quite different from outside of Asia, and how strict the FRC is, because nobody has adopted the enforcement level of the FRC. And I sensed in your voice when you were talking about reporting that there may be some pushback. And so I'm just wondering, how much pushback have you gotten from the signatories on terms of the level of reporting, and especially with changing the rules on tiering? Was that the result of pushback or not?
Sorry, we have one final question from, yes?
We're talking a lot about the importance of asset owners stepping up in the asset owner fund manager relationship.
Use your microphone over there.
My name's Anne Clements. I'm the head of stewardship of Carbon Tracker. You guys were talking about the importance of the asset owner stepping up in the asset owner fund manager relationship, but given the fragmentation of the UK pensions industry, we can't talk about that without talking about the role of investment consultants, which has been touched upon. And in light of that, I'm concerned that given the regulatory burden that asset owners now face, which is a good thing, but there are always consequences to every positive. With every positive, there's a negative. And as a result of that, we're going to see probably in reality on the ground a lot of outsourcing of a lot of stewardship, ESG, climate change related responsibilities. And I was just wondering if the panel has any comment with respect to any negative consequences that may come from that.
Okay, everything goes now. We have only 5 minutes.
Looks like I'm holding the mic, so I'll be quick. I'll try to address Marco and Alice. So look, you know, the globalization of capital really exploded in the mid-90s. In fact, that's why ICGM was born on the fringes of CII at the Watergate Hotel, no less, in Washington, D.C. And it was really an acknowledgement that as an investor with a globally diversified portfolio, you have to understand the governance regimes and the markets in which you commit your financing to. So it's part of an inbuilt stewardship obligation. If you take Japan down, there's 30% of the market is owned by overseas investors, most of them probably ICGN members. Now, I think the ways in which to avoid duplication is, well, certainly in ICGN's case, most of the national investor bodies are in fact ICGN members. So we get together with Andy Griffiths and the team at Investor Forum, AXI in Australia, once a month. It's a network called the Global Network of Investor Associations. We have a sister body, call it the sister body, which is the Global Stewardship Codes Network, which Andrea's FRC is part of. So they get together and they swap notes. So there is a degree of coordination that happens and learning that happens from each other. So that system is already in place. And I think, you know, and I actually do believe that, you know, ICGN has been around for over 25 years now. That is almost ICGN's main utility, is to convene and to enable that sharing of knowledge to take place. So that's about where we're at in terms of sharing things. So I hope that's helpful.
Yeah.
I'll have a go at answering the question most directed to me. So yeah, it is a great point. So I think the UK is definitely a leader in terms of our stewardship code, and I think we've really been kind of pushing what's expected of stewardship and what it entails for a long time now. And in terms of the reporting obligation, so I don't know that I'd say it's pushback, but we definitely hear that, you know, it's not necessarily a very easy thing to do. But we think what we hear from most signatories is that it's ultimately worthwhile to have gone through that exercise. And it really helps with that internal coordination and kind of bringing the organization together and making sure everybody's on the same page and really bought into your stewardship approach. And in terms of the tiering, we had that for the previous version of the code to help really differentiate kind of excellence in stewardship and in stewardship practice. But really, that was a policy-based code more. So we've moved to this kind of code that's really looking at your activities and outcomes from the year, not just what you say you're going to do or what you say you want to do, but what have you actually been doing in each and every year. And in terms of tiering, we've been having those discussions, but the purpose of the 2020 code update was to really kind of raise the standard of stewardship and stewardship reporting. And so we've been having discussions, and the feedback we're getting at the moment is that tiering is not necessary right now because we think we've sufficiently raised that standard. So we really want to concentrate our efforts on being able to have more organizations become signatories of the code before we look at doing any further differentiation there. So I hope that's answered your question.
Emmet, would like to chip in?
Thanks. Yeah, I think two main questions from me, one on duplication and one on sort of regulatory burden and what is reasonable to expect of asset owners right now. On the duplication question, yeah, look, I think it's a big issue. I think it's, you know, everyone in this room, I'm sure, hates PRI to some extent for the reporting that they're forced to do as a result of it. And, you know, that takes time away from, you know, actually doing the stewardship work, actually engaging with companies, and that's something that no one wants. And so that, you know, this is a priority for us. We have done some preliminary analysis internally for, you know, where are the overlaps in the major jurisdictions in which we have a lot of signatories? Where could we scale back on our reporting questions? You know, it's difficult in some respects because, yeah, we have a global signatory base. You have everything from the UK with its very leading stewardship codes to other markets where stewardship is, you know, very, very nascent. But yeah, so I think, you know, in the future there is some vague model where reporting against a leading code acts as some sort of substitute or like plug and play between the two, and I think that would make everyone very happy. In terms of the burden on asset owners, it's a very good question. It's a very tough one to quickly answer. I suppose part of it is a need for structural reform. As you say, the UK asset owner system is very fragmented. I think something that needs to happen is greater consolidation of smaller pots, building more sizable asset owners who become more product makers than product takers to some degree. I think there's also a role, it's a bit unsatisfactory of an answer, but there's also a role for collaboration here. I mean, like fundamentally, one thing you're talking about is a power imbalance between smaller pension funds or asset owners and larger managers. And you know, this is one example of power balances that play out elsewhere in the industry. I mean, if you look at private equity firms with that have a record of earning very high rates of returns, asset owners are very reluctant to ask challenging questions for fear of being shut out of high-performing funds, and so as a result, the pressure on certain firms in different asset classes is much weaker in terms of sustainability. And so, you know, one partial solution to that is greater collaboration between different asset owners.
Sorry, if Lux could call panels to an end, Dionysia just gave me that look. We are 2 minutes late on my 5 minutes, and so sorry, Mark. I really have you. If you have,
I'll be
telegraphing.
super quick.
Okay.
I will only respond to one question because I think there's only one that hasn't been tackled, which is Ava's. I think it's a really good question. For me, to be perfectly honest, I think it's complementary. Stewardship and the expectations of the private sector in sort of helping to drive progress towards a more sustainable future is complementary to public policy action that governments can take. Governments can't do it all. Private sector can't do it all. There needs to be a balance. There needs to be complementary action from both sides. That was as quick as I could do it. Sorry.
Thank you. And please join me in thanking the panelists for this great session.